You know, a lot of people talk about credit card debt and why it's such a bad idea, but the question really is also, why are credit card interest rates so high? And the reality is that credit card interest rates are always high, and they always will be high. And although there are incentives often offered to switch between, you know, card providers and things of that type, when someone lends us money to buy clothing or food, there's a, you know, whether we pay that money back is much higher risk than if we were to buy, say, a house or a car. You know, on a credit card, when we go shopping using a credit card, we're buying things that basically either get consumed typically or that depreciate in value incredibly rapidly. You know, if we buy a piece of clothing in a store for $100, the most we're ever going to get back, unless we return it within, you know, to the store immediately, you know, is a tiny amount of what we paid for it, you know, if we try to sell it on eBay or through a garage sale. So what that means is that the risk for the person lending us the money to buy this stuff is really high, because whether we pay it back or not really depends on our income. And they have no recourse of basically saying, you know what, I lent you the money to buy this stuff, now sell the stuff and give me back my money, because the stuff that we bought has depreciated or has been consumed. When we buy a house and a bank lends us money to buy a house, and if we can no longer afford the interest rate payments or the mortgage payments, then, you know, what ends up happening is that the bank that lent us the money can say, okay, look, you've defaulted on this mortgage as per the terms of the mortgage. We know we're now going to require you to sell the house. You take that cash, pay us back, and you can keep whatever's left over. But when it comes to credit card debt, the risk for the lender is much higher. We're basically buying things that drop very quickly in value. That's one of the main reasons why credit card represents such a high level of risk for the lender, i.e. the credit card company, and why they are able to get away with and why they can put in place such high interest rates. The other reason is, of course, that they want to make money. And the other reason is, of course, which ties to the first reason, is that a lot of people do default on their credit cards. And, you know, if they declare personal bankruptcy, there's very little of the money is recovered by the credit card company. They have tremendous costs associated with recovering it, or difficulties, and therefore, you know, to compensate for the potential losses when people default on their credit cards, they have to charge higher interest rates. What that means, of course, is with the effects of compounding, that having credit card debt is a really bad idea, because the interest rates are so high, you know, let's say 20%, that, you know, that within, you know, that the interest that accumulates and the amount that we owe grows so quickly that we end up having, you know, more and more debt, having bought things that are typically often worth less and less. So it's a really bad kind of, you know, equation, in that on the one hand you've got things that are depreciating or worth significantly less, on the other hand you've got a debt that's growing, and that's really a bad balance to have. You know, if we were to take on debt, typically what we would want is, you know, arguably to have the debt growing slowly and to have what we bought increasing faster, or to, you know, we don't want our debts to grow fast, we want our debts to grow slowly at low interest rates, and we want our assets to grow with high interest rates or grow more quickly. And when we have credit card debt to buy things that drop quickly in value, we have actually the worst scenario on both sides.